What if you could keep all that you ever earn? Hello and welcome to this introduction, this exposure to infinite banking. My name is Jesse Durham. I saw an introductory presentation for the very first time in 2015 to the idea, the concept of becoming your own banker, unlocking the infinite banking concept as codified and described in R. Nelson Nash's book. I saw an introductory presentation. Today I will be giving my version of that presentation after having implemented as a consumer, just as a layperson myself, this concept for going on 10 years now. And for the past several years, helping folks all across the country have more financial independence and autonomy. Now, where I started at in 2015 was my wife and I were both pursuing our careers. She was a registered nurse. I was a teacher in the state of North Carolina. I had just launched my very first business that year in 2015. We had just had our second son born, and I had a friend invite me to see this presentation on infinite banking. And where we were in the background was about $50,000 in debt. So from the outside, it looked great. We were growing as a family, pursuing our careers, but back behind the wall, we had student loan debt. We had credit cards. We had a car note. And I was just in that first year, which you business owners can relate, in launching my own business. So let me begin by sharing a quote that I saw in that room for the very first time. It's from Will Rogers. He says, "The problem in America isn't so much what people don't know. It's what people think they know that just ain't so." We're going to come back to this. It's very important. Now, as an icebreaker, and this is the teacher in me, I want to do something. I'm going to share a screen with you here in just a second. And let me give you some instructions first. So the instructions are this. I'm going to show you a screen of numbers. I want you to find those numbers in order. I'm going to time this, okay? So find the numbers in order, 1, 2, 3, 4, 5, and keep going. Go as high as you can. I'm going to give you 30 seconds to do that very thing. Are you ready? On your marks, get set, go. "20 seconds left. "10 seconds. Keep going. Finish strong. All right, that's time. How far did you go? Okay, think of that number. Hold on to that. I'm going to give you a new piece of information, and here's this mental exercise. You just went through this exercise with those particular set of instructions. Go as high as you can. I'm going to give you another piece of information, new information. I'm going to ask you to imagine a screen that looks like a tic-tac-toe graph. So X's and O's, you know what that looks like. 2 vertical lines, 2 horizontal lines. Think of a tic-tac-toe diagram. Put that on top of the same number screen. I'm getting ready to show you the exact same numbers, and I want you to find as many numbers as you can. Same instructions going in order, 1, 2, 3, 4, 5, 6. Go as high as you can, but they're going to be in this order, left to right, top to bottom, within that tic-tac-toe graph. Okay, so 1, 2, 3, 4, 5, 6. Are you ready? We're going to repeat the same exercise. 30 seconds on your marks. Get set. Go. "20 seconds. "10. And time. You got farther, didn't you? And that's the point behind this mental exercise right here, is to point out that with new information, seeing the same problem, I've already introduced you to the problem. Folks are not keeping their money, and we're going to talk about that. but I gave you a new piece of information, and we're going to question some of our preconceived ideas, and that's why the Will Rogers quote. So you got further with that new piece of information. What I'm saying is, when I was exposed to this idea from R. Nelson Nash that you could become your own banker, that I could become my own banker, I was thankfully at a very open-minded time of life. So I'm going to encourage you just to be open-minded. And that's why I had that icebreaker exercise as well. It's probably a little bit of fun. You might have laughed. You might have felt anxious. And we're going to be addressing some issues here together. It's going to continue to be a mental exercise. In fact, in his book, Becoming Your Own Banker, Nelson says that this is going to be an exercise in imagination, logic, reason, and prophecy. So those are going to be the attributes necessary to consider this mental exercise. Let me give you another quote. Out of those, imagination, logic, reason, and prophecy, Albert Einstein is attributed as saying that imagination is more important than knowledge. Now, that really strikes me, knowing Albert Einstein for who he was. For him to say that imagination is more important than knowledge, but I found that to be so. Now, as we go through this presentation, I'm going to present this information to you in the model of a play. So theme, characters, of course, there's going to have to be a plot twist, but I'm going to present this information to you in the form of a play. Let's begin. Here's the theme. The theme is what the book says. You can become your own banker. You can become your own banker. That's the theme of this presentation. There are going to be characters. Let me begin by introducing you to the main character. The main actor, the main actress is you. Of course it's you. This is your play in life. You're the main character. You are the lead character. Now, why would I say something so apparent, so obvious? Well, it's because it's so obvious that it's so important. Because you're the main character in this play, I'm heading off a question that folks will often have, which is, Jesse, after seeing this full presentation, you're going to perhaps have some thoughts of, well, this sounds too good to be true, or what are the cons to this? And that's where I will simply remind you that, well, you are the main character. I don't know how you are going to do, how you are going to think, if you are going to follow the principles and use the ideal product and understand this process that I'm going to lay out for you. But if you ever find yourself asking, is it too good to be true? No, it is just what it is. Remember that you are the main character. Okay, let's address the human problems. Remember, I started by saying that we're not keeping what we earn. What if we could keep all that we earn? We can, but we have to address some problems. These are outlined in the book as well. Firstly, there is Parkinson's law. Parkinson has this law that says that we just naturally tend to spend all that we earn. That's just a natural human tendency. We must address this every day, or financially speaking, we will lose. We cannot have financial autonomy, independence, have victory when it comes to our money if we don't fight off Parkinson's law. The next is Willie Sutton's law. Now, this law says that folks will try legally or illegally to take your money from you. Willie Sutton was an infamous bank robber. When he was asked, why do you keep robbing banks? Because he'd rob a bank, get out, rob a bank. He said, well, that's because that's where they keep the money, is in the banks. So legally or illegally, folks will try to take your money from you. This is just another human problem we have to contend with. The next is the golden rule. The golden rule says that he who has the gold makes the rules. Remember, we're not keeping our money, so it leaves us in a poor and unstable, a disadvantaged position. He who has the gold makes the rules. And then the arrival syndrome. This is, Nelson says, perhaps the most dangerous of these human problems. The arrival syndrome is that feeling or sensation that I know it all. I've arrived. Everything is perfection for me. I've personally decided to be a student, a lifelong student myself. And then the last is to use it or lose it. Now, the analogy that I like to use is imagine strapping an arm to your body, not using it for the next 30 days. You use the other arm as normal, but the one you don't. What's going to be the condition of that strapped arm after 30 days? It will have atrophied for sure. But if we use it, we can get stronger. So use it or lose it. There are financial implications is what I'm saying. These are the human problems that we must all address. And remember, you're the main character. So that's why I'm pointing them out to you. Now, once we recognize that these are the human problems that we are addressing, it's time to introduce you to the next character in the play. The next character is money. Now, I have a question for you. And again, I'm literally going to ask the question. Feel free. Anytime I ask a question, I would actually encourage you to actively pause this video to answer the question before I continue. Here's my question to you. What is money? Feel free to pause it. Actually answer this for yourself. I highly encourage that. What would you come up with? I'm curious. I love making this presentation to live audiences because I can get the feedback, but here in this video presentation, that's why I'm going to ask you to just pause this for a second. Write it down. Write down what you think money is to you. Now, here's the answer. Money is simply a means of exchange, meaning that we would exchange money for gas in the car, food in the refrigerator, vacations that we take the family on, etc. And those things likewise are sold or exchanged for money. So money itself is just a medium, a means of exchange. Now, money being this second character, there are some things to consider about this character. When it comes to money, recognize that wealth must reside somewhere. It must be warehoused somewhere. Now, I'm actually using that word warehouse because Nelson wrote a second book. It's called Building Your Warehouse of Wealth. You can hold that for later. But wealth, capital, money, it must reside somewhere. Here's another question about this character. Are your dollars worth more today or in the future? You can actively pause right here. Are your dollars worth more today or in the future? Pause and come back to this. When you're back, recognize this. Dollars are worth more today than in the future. Here's how you can know that. What did a candy bar cost 50 years ago? What did it cost 5 years ago? What does it cost today? And then consider in the future, what might a candy bar cost 5 years from now? What might a candy bar cost 50 years from now? So your dollars are more powerful. They are stronger today. Next question. Are taxes likely to go up or down? Now, I'm not giving advice. I'm just asking a question. Are taxes likely to go up or down in the future? I would say it's quite possible that they are going to go up and that we may be taxed on more things in the future. Now, would you rather pay taxes on the seed or the harvest? Again, you can actively pause here. Would you rather pay taxes on seeds or the harvest that those seeds can produce? What did you come up with? I would rather pay taxes on the seed, knowing that the harvest can be much more bountiful. Do you follow me on that? Again, these are just attributes. These are attributes of this character in the play in your life. Money. Now, one more is natural law. The sun is in motion. The earth is in motion. The wind is in motion. Our lungs are in motion. Blood's flowing through our veins. So motion is a natural law. Now, when it comes to money, do you want your money to be lively and moving or stagnant? Food for thought right here. Would you rather drink water from a flowing location or a stagnant pond? Do you understand what I'm saying? And then another question about this character, money. What do you know about compound interest? Does compound interest exist? Do you believe in compound interest? Now, again, going back to Einstein, here's a quote that I love. Einstein said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Feel free to read that again. So here's how I will present compound interest to you in another mental exercise. Let's say I could make you an offer today of $1 million today. Let's say I could offer you $1 million today, or a penny that doubles in value every day for the next 30 days. $1 million or a penny that doubles. Again, I'd love for you to write this down. I'd love for you to answer this in your own mind. Which one are you taking? $1 million is a lot in comparison at face value. with a penny that doubles every day? Well, let's run this scenario out. You don't have to take my word for it. Feel free to pull your own calculator out. Now, I'm going to show you the numbers on the screen. Well, obviously, day one, you've got a penny. Day two, you've got 2 pennies, 4 pennies, 8 pennies. It continues. I can tell you, after a week, you do not even have $1. If you chose the penny that doubles every day for the next 30 days, you don't have $1 after a week. You don't have $100 after 2 weeks. The third week is equally unimpressive. Unimpressive. Underwhelming. Meanwhile, the person that chose the $1 million is living it up. But something extraordinary happens in the last 3 days. On day 28, you crack $1 million. It's 1 point something, which means that on day 29, it must be 2 point something, which means that on day 30, you have over $5 million. Now look at that difference. That's a difference of over $4 million in this scenario. So we cannot underestimate what the power of compound interest uninterrupted can do for us. Okay, here's the plot twist. We've got a couple of characters in this play. You, money. Here's the plot twist. Dun, dun, dun. Everything is financed. You, money, you're in the play together. Everything that you do is financed. Your household, your business, any investing that you do, everything is financed. Now, conventionally speaking, there are only 2 ways to finance: credit and cash. Credit meaning debt, cash meaning the money itself, the dollars themselves. So let's look at these 2 scenarios. Let's look at credit first, and let's recognize that there's going to be a baseline here of 0 for both credit and cash. 0 is going to be a baseline. So for accessing, utilizing credit, you go below that baseline because you have to go to someone, of course, ask permission, fill out the application. They'll let you know if you qualify. You got to front collateral. You're going to be paying interest, etc. Okay, those are all valid questions to ask for ourselves. And when you do, you go below that baseline and you build back out by making payments. That's one way to conventionally finance, is to use credit, or to use debt would be another word. The other model is cash. The other model is saving up money until you have the amount that you want. And notice that I didn't say invest right here. Big distinction. There's a big distinction to be made between saving and investing. With investing, there's always an element of risk. We're simply talking about saving right here because everything is financed. We can use credit or cash. So you save up until you have what you want, and then you liquidate it. Now, after you've saved up what you wanted, you should be asking yourself, where did we put that? Did we assume any risk where we did decide to put that money? How easily can we access it? Are there any terms and conditions? Are there taxes on the growth? If there is growth, penalties, fees, the time associated with saving up that money because it didn't happen overnight. Lots of questions to answer there as well. But the second way of conventional finance is paying cash for it. This is for my cash is king, folks. But again, notice the baseline, 0. When you liquidate those savings to buy what it is, to pay cash for what it is that you were going to buy anyway, you go back to 0. So the baseline in both of these scenarios is 0. Now, cash saves you some interest that you paid in the debt scenario, but remember and recognize that the baseline is 0. You end up at 0 is the net result. But what if there were a way where you could experience a constant upward growth trend of your capital? And that returns us back to that compounding word. So that's just me planting the seed of a question right there. What if? And let's say that I were your local banker in your town and you'd been saving up in your bank. Let's say you had $25,000. Now, for this scenario, don't get bogged down in the numbers. We could be talking about $2,500. We could be talking about $2.5 million. Just notice the principle here. Don't get bogged down in the numbers. I want you to notice something. Let's say you've been saving $25,000 in the bank. Let's say that the bank were giving you 4%. I know that is certainly not the case across so many years of recent history, but let's just say, and prior history, of history altogether. But let's just say the bank could give you a guaranteed 4%. Let's just say they would on your $25,000. But you come into the bank one day, you're saying, well, I need to go get a vehicle. Let's just say this is a vehicle purchase. You're going to use your $25,000 where you're earning that 4% to go get a vehicle. And I, as your banker, say, well, don't do that, John. How about the bank will give you a loan? I like you. I'll only charge you 6%. Leave your money growing here, growing on itself, compounding at the 4%, and you'll come out on top. Now, here's a great question, and this stuck out to me the first time I heard it in 2015. Is the local banker telling you right? If you're earning at 4% uninterrupted while paying 6%, are you coming out on top? You, the consumer that wants to go out and buy this vehicle. And we've all bought vehicles. Think about that. Are you in your first vehicle right now? Some of you will be. Some of you will be in your first vehicle. I'm not in my first vehicle. God willing, I'm not in my last vehicle. You're probably not either. This is such a normal transaction that we do. Here's what I'm trying to point out right here. How much of the money that you've spent on vehicles that you've bought before do you still have today? If you're like me, it's none. That's even a weird sounding question when I heard that the first time. How much of the money that you spent on vehicles in the past do you still have today? None. Okay. So am I then telling you the truth as the banker that I'll say, well, if you do it this way, leave your $25,000 compounding at 4%, the bank will make you a loan for the $25,000 that you need for the car, will only charge you 6%. Are you going to come out on top? Let's see. That breaks down over 5 years, so 60 months over 5 years, to a monthly payment of $483.32. Let's run the other scenario. $483.32 times the 60 months over the 5 years is going to be right at $28,999. So just shy of $29,000. So you would have paid the bank about $4,000 in interest. The $25,000 plus the interest, an extra $4,000, almost $29,000. But let's check the other account. What if you had left the $25,000 compounding over the same time frame? Here's what it is, $30,525. Well, where did that extra $1,500 plus come from? From that third C, uninterrupted compound growth. That's the power of it in action. Again, it's time to introduce the next character. There's you, there's your money. We have the plot twist that everything is financed. Credit and cash are the conventional routes to do that. The next character then is someone that we've been introduced to, the bank. Banks are a character in this play of life. Let's take a look at banks. Here's a very superficial question, but it's valid. Aren't banks the nicest buildings in the nicest part of towns with the best kept grounds? Yes. And aren't they all over the place? My town, your town? Yes, absolutely. Let's take an inside look at the banks, though. Webster says it's an establishment for the custody, loan, exchange. We just looked at a loan, exchange, issue of money, extension of credit, facilitating the transmission of funds. Now, at a real simple level, a bank is where something is amassed. Here are some examples. River, bank. Snow, bank. Food, bank. Blood, bank. So bank is a place where there are these deposits, there are these issuances, okay? So a bank is where capital can be amassed. To exist, then, these entities must have deposits. All right, so we know this, and we're even conditioned. I mean, we have direct deposits. Normally, most of us, when we're earning, that's directly deposited into a bank. We never even see that money. That money never touches our hands before it's in that business. But here's a big question. I remember this question as well the first time I heard it. To a bank, are deposits a liability or an asset? Let me ask it again. Think about this. Feel free to pause this till you have your own answer. It's going to be a good mental exercise. To a bank, are deposits a liability or an asset? In my mind, when I first heard that question, I certainly said asset. But let's take a look at whether that's true or not. Here's how banks really work. So here's the bank. Again, I'm going to use that same scenario of you're making a deposit or you have money in the bank. Let's say it's $100,000 and the bank is paying you 4%. Again, could it be 10,000? Could it be 10 million? Yes. Don't get bogged down. Decimals move left and right in the numbers. Notice what's happening here. Let's say you have a home mortgage where the bank charges you 7%. Let's keep going. Whoever sold that home, when they earn, where are they going to put that money? Remember, wealth must reside somewhere. That money goes into the bank. If you go to the bank for a car loan, let's say they charge you 8%. Whoever sold you the car, when they earn, where are they going to put that money? The bank. Let's talk about a home remodel. Many of us, this could be a sore point, but let's say the bank charges us 9%. Whoever the contractor is, when he earns, where does he put that money? The bank. So on debt consolidation, 12%. We consolidate the credit cards, back to the bank. Let's see what the difference is. What kind of a spread, let me use that word, is the bank earning? 3% on the home mortgage, because 7% is 3% more than 4%. Do you follow me on that? Okay. Nice and slow here. 8% on the car. But again, they were only paying us 4% on our money. So the bank earned another 4%. 9% on the home remodel, but again, they only paid us 4. That's a difference of 5. 12%, that's a difference of 8. Feel free to watch this more than once. I needed this real slow when I saw this the first time. Let's tally these up. 3%, 4%, 5%, 8% makes 20% total. But remember, the bank said that they were going to pay us 4%. So how did the bank come out? What percentage did the bank earn? They owed us 4% on our deposit. They made this spread. 20% minus 4% is, right, 16%. But no, the bank earned 500%. Now notice this. This is huge. 4% is what they owed us. They earned 20% total. 20% is 5 times what 4% is. So 20% is 500% more than the 4% that they were paying us. Folks, banks are making bank. And whose money did they use to do this with? Ours. What risk did the bank assume? None or very little. They had collateral in a lot of these scenarios. So they didn't take risk. They had collateral in these interactions, and they were making bank. Now, you might see anything from 400% to over 1,200% that banks are earning. I encourage you to look this up for yourself. 400%, 800%, 1,200% the banks are making on our money. Here, let me remind you of our plot twist. Our characters so far are you, the main character, money, now banks. But remember, everything is financed. Everything's coming together to point us to this problem that the average American is bleeding out interest dollars from conventional finance. Remember, everything's financed. Either we're using credit or cash. If we're using credit, we're paying interest. If we're using cash, we're missing out on the opportunity to have earned interest on our money. Now, Nash does a great layout here that exposes us to the problem that the average American is facing. And he says that autos, housing, living expenses, and savings are 4 general areas where we could be spending money. Now, he's very generous when it comes to savings. He assumes here, generously, that the average American is saving 10%. Now, notice again, I did not say investing. I said saving. Saving 10%. That is not the case. Again, don't take my word for it. Look up what the average American is saving today. He's very generous by saying 10%. And he says that, let's say we're spending 20% of our income on autos, another 30% on our housing, another 40% on living. And living is just going to be the assortment of expenses that we have towards vacations, clothing, just lifestyle, whatever that may look like for each of us. And then he also shows the amount of interest that we pay on each of those categories to the tune of 34.5 cents of every dollar that we earn, the average American is bleeding out, on average, a third of what we are earning. Those are dollars that leave our hands forever, never to return. What if we could get that back? We can. It's time for our next character. The next character is the ideal asset. So you're in this play. Money's in this play. Banks are in this play. The next character is about to enter, but actually this will be another active pause situation on this video. I'd love for you to get pen, paper, type this on your phone, whatever it is that you need to do. If you were describing your ideal asset, what characteristics would it have? Again, I love asking this question in front of a live group, but I'm asking you to pause right here, write down as many characteristics as you could think of the ideal financial asset. What type of characteristics would it have? Hit pause here. When you come back, I'm here to tell you that there are more than a dozen reasons as to why I am certain that whole life insurance is the ideal financial asset. Now, I know it may seem like I just switched gears on you by mentioning life insurance. I get that. Let me remind you, Will Rogers said, the problem in America isn't so much what we don't know, but what we think we know. That just ain't so. I'm asking you to be open-minded right here. I'm telling you there are more than a dozen reasons, but let's take a snapshot look at whole life insurance. Life insurance has been around for over 200 years. Now, I'm not just talking about any old type of insurance. I'm saying a properly structured whole life insurance policy from a mutual company that pays dividends. That's very specific. I'm going to repeat it. A whole life insurance policy from a mutual company that pays dividends. Now, as an industry, having told you that life insurance is over 200 years old, it predates our tax code. It predates the IRS, which was started in 1913. That's a big thing to notice. As far as those characteristics go, I'll enumerate them to you. We can elaborate on these later. I'm just exposing you to what they are. With a properly structured whole life policy from a mutual company that pays dividends, there is high growth. There is consistent growth. It's a conservative asset. It's liquid. It's guaranteed. There are tax advantages. No market volatility. It does yield income besides capital gains. It can have creditor protection. It is a hedge against inflation. You have control. It's a transferable asset. It's easy to manage. There are no hidden fees or penalties. It's reputable and it's private. Now remember, wealth must reside somewhere. We're introducing this new character in the play of whole life insurance. And to make a connection, let's look at banks again for a moment. Did you know that banks own more in life insurance than they do in real estate? Banks, in fact, are the largest purchasers of whole life insurance. You can look it up. It's a term called BOLI, bank-owned life insurance. Now, let's consider some folks who have actually purchased what I'm calling this ideal asset, the whole life insurance policy. Does Walt Disney ring a bell? Now, Disney launched Disneyland from using cash values from a couple of whole life policies that he had. Ray Kroc doing what he did with McDonald's, using life insurance cash values. Rockefeller, Rothschild, J.C. Penney covered overhead during the Great Depression because he had whole life insurance. Some more modern names: Sam Walton from Walmart, Jim Harbaugh, very interesting case study, being paid and having whole life insurance as part of that deal. It's a really neat thing. You can look that up online. Joe Biden, President Joe Biden, has whole life insurance. Miss Christopher, that launched the Pampered Chef that was eventually purchased by Berkshire Hathaway, Warren Buffett's company, she launched that business idea using cash values from whole life policy. Now, remember our theme. We've been introduced to several characters. We're aware of the plot twist that everything is financed and the average American is bleeding out 34.5%. in interest alone. The theme here of this whole play, though, is that you can become your own banker. I want to remind you of that. Here are the 3 simple rules that I heard about infinite banking when I first saw a presentation. Pay yourself first, pay yourself with interest, and recapture the money. Pay yourself first, pay yourself with interest, recapture the money. Now, because I've introduced whole life insurance into this play, it's necessary for me to make some precursory comments on premiums. Because you do put all of your money into a bank, don't you? Okay, so when you decide to put money into this ideal asset, into a whole life insurance that's been designed this way, that's the number that you get to determine. Just like you determine how much to deposit into a bank, you can determine how much premium you want to pay into your private banking system. Now, age. Lots of folks, and here again, this is our preconceived notions about life insurance. Age doesn't matter when it comes to whole life insurance being constructed, being built for banking purposes. And here's how you can know that. If a 20-year-old and a 40-year-old and a 60-year-old apply for life insurance, who's going to get the most death benefit on their policy? Well, the youngest person. Of course, we all know that. Same folks, the 20-year-old, the 40-year-old, the 60-year-old, all go into the grocery store with $100 to spend. Does any one of them get more groceries with the same $100? No, of course not. So age doesn't matter, is what I'm saying when it comes to banking. Banking is just a process. It exists, and you can do it for yourself. And then again, right there about the death benefit. I believe that everyone should have an appropriate amount of coverage, of protection, to be sure. But R. Nelson Nash also said that our need of finance is far greater than our need of protection. And when you implement this infinite banking concept into your life, you can ultimately end up with more death benefit than you could have acquired in the first place. Now, I would like to point this out, that the author, Nelson, and he has graduated, now is the word that he used. He's passed. He did say that if he were rewriting the book, he would not have included illustrations. So you will find illustrations in the book, and some things have changed over time. Not banking, not whole life insurance, but tabular details have changed. But life expectancy has changed. Medications have improved, etc. So again, notice the principles that I'm going to show you, expose to you while we're looking. And remember, decimals move left and right. Remember that money spends for everyone the same, regardless of age, etc. In this policy illustration, let's say that you chose to fund your policy to pay a $10,000 premium. Again, could it be less? Could it be more? Yes, it can. But let's say that $10,000 is what you chose to fund your private banking system with. You'll see a death benefit shown here. You'll also see that there is a cash value. Now, when you're looking at a policy illustration, you'll see values that are guaranteed. This is a contractual, legally binding piece of private property, an agreement between you and the insurance company. It's a unilateral contract where there are guaranteed cash values that you can leverage and borrow against. And there are also non-guaranteed amounts, and that just simply includes a dividend. Remember, I said that I personally own multiple policies from multiple companies, all of which have paid dividends consecutively without missing a single year for over 100 years. Now, just real quick, think of the history that has transpired over the past 100 years. Great Depressions, World Wars, pandemics, .com, housing bubble, etc. Y2K. If you remember that, you're my age, you do. These companies have paid dividends consecutively without missing a single year for over 100 years. But that's a non-guaranteed feature of a contract, and yet the track history is that these companies have paid them for over 100 years. So those are non-guaranteed values. Let's simply look at the guaranteed values of how a policy could be structured. And again, every policy should be custom built for the individual. these numbers can and should be different based on your situation. But for illustrative purposes, let's show that you could access a value of $5,811. Also in this illustration, I want to notice that the premium that you have chosen is consistent over time. Now, there is some flexibility there that we can get to later, but just notice now that a level premium, a steady number, is what you want to pay into this system, is what you want to fund your private banking policy with. You can see that the death benefit as well goes up year over year. By paying more premiums, the death benefit can increase when it's been built this way. It does not have to stay level. It can grow and increase. And because the death benefit increases, the cash value increases more also. It inherently must. Those two values are correlated to each other. When premiums are paid, death benefit goes up, cash value goes up. And you'll see that growth of the cash value exponentially increases over time. And this is a big thing I didn't catch on to early enough, that the cash value of a policy must eventually equal what that greater, larger death benefit number is. Now, this is a policy. This is a 121 policy, meaning a policy that would mature at the age of 121 years old. So the cash value over time must eventually equal that future greater death benefit amount. And the cash value also is a net present day representation of that future death benefit amount. But the cash value is the amount that you can use, that you can leverage, that you can borrow against. Let's return then to our car example. Let's say that you owned a policy that had been built this way for banking purposes. Let's use our same car scenario that we did earlier, shall we? Let's say that you fund a policy because you expect to get another car in the future. I will, you will, I'm sure we will. So let's say that you fund your policy for 4 years. $10,000 is your premium that you're funding into your policy. In year 4, you want to access $25,000 to go out and purchase the car. Now, an insurance company, just so you know, will ask you 2 questions. Once they verify who you are, they'll say, well, Mr. Durham, how much of what's available do you want us to send to you? And do you want a check in the mail or a direct deposit? How do you want that? So when you access the $25,000 via a policy loan from your contract, you can use that money, of course, go out and buy the car just like you would have anyway. You get to pay the cash for the car. And let's say that you set it up where you're going to make $500 monthly payments back to yourself. Remember this scenario? Pay yourself first, pay yourself interest, recapture the money. So you're paying yourself first by paying premium. You're going to pay yourself interest because you borrowed $25,000. So you're going to pay more than that back because you're going to be a good banker. You want to be able to make bank like the banks make bank, except it's you instead of the banks now. So you're going to charge yourself some interest. Let's say it's $500 monthly payments. That's $6,000 over a year that you're going to be making as payments back to yourself over the next 5 years. Again, you should notice I'm just using the same exact example that we showed earlier. $25,000 car purchase, $500 approximately a month repayments back to yourself. Look at the cash value that we see after 5 years of repayments, of being your own banker, has transpired. Your cash value reflects a growing number because remember, you consistently kept funding, you kept paying premiums to this private banking system. So your cash value kept increasing. And the payments for the car that normally would have gone to a bank, they've just gone back into your system. So not only do you have the car, it's bought and paid for, parked out in the driveway, but you've gotten all that money back into a private banking system that you own and control. And again, just for a bonus, what did the death benefit do? It went up as well. But let's presume to walk this out another time. Let's say it's time to get a second car. Maybe it's time for the wife to get a car or whatever the case may be. Child, you're still paying your $10,000 premiums. You take out another $25,000 to go get the next car. You pay the $500 a month back to yourself again, same as we did the first time. The question is what happens after those 5 years go by? You've got 2 cars bought and paid for out in the driveway. You could sell them, you could donate them, you could still drive, whatever it is that you want to do. And your death benefit has grown the whole time, and your cash value has grown the whole time. If you'll notice the values there in your guaranteed cash values, they are more than what you spent on the car. So you've got the cars and you kept the money. Again, I'm trying not to get bogged down in the numbers here, but I'm trying to show you that you've got the cars and you kept the money. And if this could work for cars, couldn't it work for a college education? Couldn't it work for your vacations? Couldn't it work for fun projects like a remodel? Couldn't it work for your recreational vehicles? Couldn't it work for your investments? Couldn't it work for business equipment? Couldn't it work for weddings? Couldn't it work for your home mortgages or investment properties? Couldn't it work for whatever it is that you're already doing or that you want to do? Absolutely. Remember, you're only changing one thing. You just changed the location of where your money went first. You just added one step to what it is that you're already doing. You changed the direction of your money. You decided to pay premiums into a private piece of property that you own and control. Use that entity for the financing that you do in life. And because you're the banker, you get to recapture that plus the interest, plus any profits that you would experience. You're paying yourself first, you're paying yourself with interest, and you're recapturing all the money. Now, this would have been very relevant to me when I was first introduced to the infinite banking concept, was how to use infinite banking for recapturing debt. And notice I'm not just saying paying off debt, but recapturing debt. So let me provide a scenario where someone is $434,164 in debt. They decided to fund their policy at $30,000 a year or $2,500 a month. Now, again, don't get bogged down in what these numbers are. You might owe less or more. You might decide to pay premiums less or more than what I'm showing here, but notice the principles. Notice the process in action. This person has outstanding debts with Visa, Discover, a dental, Home Depot, the Best Buy, an Apple Card, Rooms to Go, the car note, and the home mortgage. Now, the total debt, again, $434,164. I'm showing the interest rates here. I'm showing how long it would have taken to pay off each of these items at their monthly minimums. So let's see what it would look like if we incorporated owning a policy, funding a policy, and using a policy to pay these off and recapture the money. So if someone were to fund $30,000 for their first year, they would have paid off the Visa card, the Discover card, and the dental debt in that first year and paid some down on the Home Depot. Now, notice that there was $17,401 available to leverage from that $30,000 premium. Now, I would like to clarify here that there is never a loss of value with a policy. The $30,000, remember, that's premium that's paid into a policy. That grows and that compounds. Remember, we've talked about the credit method, the cash method. This is the compounding method. That value continues to compound uninterrupted, but because that premium was paid, it created this separate value, the cash value that we can leverage, and to the tune of $17,000. So that's a significant value, even in the first year of this policy. Especially so knowing that that will grow and compound over time. So that $17,401 is what was used to pay off the Visa, the Discover, the dental debt, and pay down on the Home Depot. That's what the year one looks like. Now notice that means then that the $75 a month, and the $80 a month, that can be redirected, can't it? Where can that be redirected? Well, to this same process, to the same system. Now, let's notice that just over the course of the next year, that the Home Depot is going to get paid off from its normal, regular, scheduled payments. Now, let's notice that by paying the $30,000 premium for the second year, it creates a policy loan available amount $18,082, plus you've been making payments to yourself that used to go to Visa, that used to go to Discover. That's an additional $3,272, so $3,272. So totaling $21,354 that you can pay towards the next debts. So that means that now we are paid off the Visa, paid off the Discover, paid off the dental, paid off the Home Depot, paid off Best Buy, paid down on the Apple card. Now we're entering the third year. You're paying $30,000 for the third time. There's a policy loan available of $28,277. Loan repayments, remember payments that used to go to someone else, now are a total of $7,944 that you've paid back to yourself, totaling with $36,221 that you can throw at the next debts. So now the Apple card's been paid off. Rooms to Go has been paid off, which leaves just the car and the home mortgage. Now in the fourth year, we've paid $30,000 again. We've got a policy loan available of $30,101. We've made loan repayments of $13,716, totaling $43,817. That's what we use to pay the car completely off, just leaving the home mortgage left where we're making our regular scheduled mortgage payments. So in year 5, to recap, we've made policy loans of $32,572. In year 6, policy loans of $33,820. And in 82 months, 6.8 years to be exact, we made a policy loan of only $19,363. And I say only because, well, that's all that was necessary going along with the regular mortgage payments that we've been making this whole time. That's all that was necessary to completely pay off the home. So you can see how all of these debts were paid off after only 82 months. So ballpark it at 6 years. Every debt is paid in full. So what does it look like after this time? We not only paid off all these debts, but we've created this private family banking system that's now producing more in cash value each year from here on out for the whole rest of our lives. And I say whole lives because we're using whole life insurance. Pun's always intended there. We've created this private banking entity that produces more in cash value than we're even paying in premiums. We've cleaned up all that cash flow that used to go out to third parties. So now we have this private banking system. We've cleared our cash flow that used to go to all these other different areas, and we can grow and expand this private banking system. Because we paid ourselves first, paid ourselves with interest, and recaptured the money. We didn't just pay this off, but we got the money back. And again, what I can tell you in my own experience is that while paying off the debt that we started with back in 2016, not only did we pay off our debts, but we were able to get that money back into our private banking system and transition to where we use our private banking system, not for debts anymore, unless that's just something that we choose to do investment-wise, business-wise, but for things that we do in the future, things that move us forward towards even more financial independence and autonomy. In fact, Nash would say in his book that the eventual result is that when we get the snakes and dragons out of our lives, to use his language, we can get to where we eventually have our income equal to the premiums that we pay into these policies that we own and control. Now, it's not something that happens overnight, but it's something that we move towards so that the next generation has a completely different starting point than where we did, owing the car people and the student loans and the credit cards and everything else. Now, let me give you the principles of infinite banking. I've pointed out the problem, okay? The plot in this play that everything is financed. You either pay interest or you forfeit the opportunity to earn interest. I've pointed out the process of banking to you. We've talked about the ideal product. Let's talk about the principles of infinite banking. Nash's number one principle was to think long range, was to think about Who controls the banking function over the course of your life? And maybe not even just your life. For you legacy-minded folks out there, folks that believe in leaving an inheritance to your children's children or beyond, thinking intergenerationally. So his number one principle was think long range. What if you could create this tax-free access to capital environment that you own and operate and profit from for your whole life? You control and profit over the banking function for your whole life. And you create a system that spans intergenerationally. And every time that someone does graduate, someone does pass, there's going to be a tax-free windfall of that entire death benefit to the next generation that fills into your system. Now, Nash's second principle is don't be afraid to capitalize. This is all possible because you don't hesitate to capitalize your system, to capitalize over a long period of time. Whose banking entity is this? Who owns this? Who controls this? Who profits from it? So you can't hesitate to capitalize your own private banking system. An example that I give right here is a picture of our two boys in a mulberry tree that we planted years before they were even born. And because we planted that tree, we've been able to enjoy watching them climb up in this tree every year and eat from the fruit off of this tree because we capitalized that years ago. Nash's next principle is to be an honest banker. If you're going to be a banker, then he says, don't steal the peas. For that story, you'll have to get into the book. But he says, be an honest banker. If you would have paid interest to a commercial bank, you should give your capital a true market value as well. You should pay yourself with interest. You should charge interest on your capital by being a good banker. Don't steal the peas. Be an honest banker. And if you ever question that in the future, if that ever comes up in our conversations or in your mind, what's the opposite? Would you want to be a dishonest anything? Okay. Whose system would you be robbing from anyway? This is your private banking system. Be an honest banker. His next principle is to not do business with banks. Not do business with banks outside of savings and checking. I have savings accounts, checking accounts, sure, for those conveniences, online banking, etc. But having the option of not doing business with banks mean that we retain the control, we retain the profitability that banks experience. So he says, don't do business with banks. And if everything that I've shown you so far is true for cars, is it not true for farms? Is it not true for businesses? Is it not true for nonprofits and churches? Isn't it true for everyone? If everything's financed, and it is, that exists for households, investments, businesses, nonprofits, everyone. And then the last is to rethink your thinking. I've introduced you to perhaps a lot of new concepts, or perhaps you had some preconceived ideas on some concepts and you've been given that new piece of information. I'm just asking you to consider this play of life where you, money, banks, and whole life insurance exist with this plot of everything being financed, and remembering the theme that you can be your own banker. You can control the banking function in your life, and you can profit from it. Now, this has been a lot of information, but a saying that helped me for the first time when I'd been sitting for over an hour watching information on this mind-blowing concept was that, well, how do you eat an elephant? How do you eat an elephant? One bite at a time. So while this has been a lot of information, I'm going to, of course, encourage you to watch this. Again, write down questions. Take notes for yourself. And remember that at the end of the day, here's another quote for you. Warren Buffett says that if poor people would just do what rich people do, they wouldn't be poor anymore. Now, it's my belief, and I've picked up this philosophy. There's another P word for you. We've been talking about the process and the ideal product, and I've given you the principles of infinite banking. The philosophy that I've gathered from Nash is that when you know what's going on, you'll know what to do. So I'm here to simply expose you to the idea that you can become your own banker. And when you know what's going on, you'll know what to do. And what are the two scenarios from here on out? Yes, I've shared my story with you some that my wife and I got started with our first policy starting in 2016. We got our first policy after seeing a presentation, reading this book, having consultation calls with an infinite banking practitioner. And we got started on recapturing that debt that we had, paying off the student loans and the credit cards and the car note, and getting that money back into our family. What I'm pointing out to you too, or asking you to consider, is knowing what you know now. If you live, are you or are you not better off implementing this concept? I'll let you answer. When, and I don't say if there, I say when, because it turns out that 100 out of 100 Americans die. When you graduate, will your family be better off or not if you had implemented this concept? I'll leave you to answer that as well. When you know what's going on, you'll know what to do. To date, we've built a private family banking system of multiple policies from multiple companies. We've used our policies for everything from paying off those tens of thousands of dollars of debt to buying business equipment, making real estate deals, covering recurring expenses, preparing for passive income in later life, building a financial system for our family intergenerationally. We've covered all the generations in our household, building this private family banking system. Now, I know some of you may be saying, Jesse, where were you 20 years ago? I get it. I felt the same way in 2015 when I first saw a presentation. Knowing what you know now, though, what are you going to do? We're going to finance everything that we ever buy from here on out. What if you could do what you're going to do anyway and get the money back? And have I ever said anything about you having to work harder, take additional risk, lose control, or change your cash flows? No, you could just consider adding one step to what it is that you're already doing and become your own banker. And I don't know how long our life will be, but I know that we'll be here for all of it. So what do you do now? Now that you've been exposed to this idea of being able to control and profit from the banking function in your life, I'm going to encourage you to check out the book, Becoming Your Own Banker, 5th edition from R. Nelson Nash. I'm going to encourage you to get in my contact info. There's information for my website, YouTube channel, my calendar, where we could have a private one-on-one consultation call about what it could look like for you to implement infinite banking into your household or your business or your investing, whatever it is that you're already doing. And this has been a great pleasure for me. I look forward to our next conversation. Remember, live and leave a lasting legacy. My name is Jesse Durham. You can find me at durhamtalents.com. I hope you have a great day. Take care.